Hello and welcome to a brand new episode of ET Market Smart Talk, a show where we engage with top experts to provide complete insights into current market trends and their impact on stocks and sectors. Well, I'm your host, Shatajanand, and in this episode, we are diving into the world of fixed income investing. What's working, what's changing, and where the opportunities lie. Well, joining us today is Puneet Pal, Head of Fixed Income at PGIM India Mutual Fund, a veteran in the field with a sharp pulse on debt markets. Now, with global central banks navigating geopolitical uncertainty, the RBI managing liquidity with a steady hand, and FPIs pulling back from Indian bonds despite strong macro fundamentals, that's a lot to unpack. We'll explore why the 3 to 6 year corporate bond segment is drawing investors' attention and which makes a AAA PSU GSEC spread historically attractive and how investors should think about investment horizons and fund strategies in the current environment. Well, let's get started to the show. Welcome to the show, Puneet.
Thank you very much. Thank you, Shatish, for having me here.
Thank you so much for taking the time out, Puneet. And let's just quickly start with the corporate bond segment. Why is a 3 to 6 year corporate bond segment seen as an attractive investment opportunity right now?
Yeah, we see the 3 to 6 years AAA PSU segment as an attractive opportunity, simply
Okay.
because of the fact that we foresee that there won't be any rate cuts over the next 6 months till December at least.
Okay.
Given that RBI has indicated that there is limited room for monetary policy support to support growth going forward, and they have changed the monetary policy stance to neutral from accommodative in the June 6th policy, which makes us
Hmm.
believe that there will be status quo on policy rates, and that makes duration play limited in terms of overall returns from the fixed income perspective, and accrual an attractive opportunity. And when we talk about AAA spreads, they're currently around 60 to 70 basis points over corresponding maturity G6, and that is I will say a pretty decent or attractive spread, because historically, in a rate cutting cycle, which is followed by abundant liquidity in the banking system, we have seen the spreads compressing to around 40 basis points. So there's
Okay.
still some scope for the spreads to come down, which can lead to better returns, and that's why we see this 3 to 6 year segment in the AAA PSU space to be a better risk-adjusted investment opportunity.
Absolutely. You did mention about the RBI probably not cutting rates in some time now, but are there any other reason which makes current spread between AAA PSU bonds and GSEC historically attractive?
Yes, because RBI has committed themselves to maintaining adequate and surplus liquidity to the tune of
Right.
1% of the NDTL. So that means
Hmm.
that the liquidity in the overall banking system should be in excess of 2.5 lakh crores,
Sure.
which is a trigger for the spreads to come down over a period of time, because
Hmm.
the money will follow higher yields. And considering that AAA PSUs, let us say in the 5 year space, are trading anywhere between 675 to 685, and
Exactly.
corresponding GSEC yields of the same maturity are around 610 to 615. It makes sense that one can enjoy a higher accrual as the rate cuts take a pause, and overall the high accrual will lead to higher returns. And if there is a spread compression, which we do expect over the next 2 quarters, then that
Hmm.
can add on to that higher accrual.
Absolutely. Now, Puneet, let me also get your view on the. You did talk about the liquidity that RBI is going to maintain, but how is RBI's stance on liquidity and the rate transmission influence the short-term bond investment strategies?
Yeah, so we already seen banks reducing their loan rates as well as deposit rates. So I think rate
Right.
transmission is happening, and it's crucial for RBI to maintain this excess liquidity in order for rate transmission to continue to happen. And
Right.
that's the reason why RBI is committing themselves to maintaining this surplus liquidity in the banking system. So
Hmm.
overall, if we look at the durable system in the liquidity, which includes government balances, then they are anywhere in excess of 5.5 lakh crores. And as and when the government spending picks up, we're likely to see more liquidity flowing into the system, which means that
Okay.
your rate transmissions through the banking channels will pick up pace.
Absolutely. Now, if in case somebody is interested in investing right now, what's the kind of investment horizon is recommended for those who want to allocate to short-term or corporate bond funds at this point in time?
Will definitely allocate. I mean, advocate almost anybody who is investing right now to invest for at least 12 to 18 months. I think that's
Okay.
the bare minimum that one needs to keep in mind while investing into short-term or corporate bond funds, because
Hmm.
uh, when we're talking about better accruals or the spread compression, to take advantage of that, I think one needs to be invested at least for 12 to 18 months to ride out that spread compression. So I will advocate 12 to 18 months as an investment horizon for investing into short-term or corporate bond funds.
Right. So 12 to 18 months is the ideal time horizon. Now, Puneet, let me also get your perspective on what's happening on the international front. In fact, how have global central banks like, let's say, the US Fed and the Bank of Japan or the BOJ responded to the recent geopolitical uncertainty? We saw US Fed decreasing rates, and on the other hand, BOJ or Bank of Japan sort of, raised interest rates a little bit in the past. How are you reading into all this?
Yeah, I think it's a very pertinent question, Kshitij, and it's I think going to remain so at least for the foreseeable future. So I will say that every central bank is reacting first to their domestic inflation growth dynamics.
Hmm.
Like RBI, in our case, they have put emphasis that whatever policy they are doing in terms of monetary policy or the conduct of the entire monetary policy is driven mostly by domestic factors, which
Sure.
is, in a nutshell, is the growth inflation dynamics. And that is the case with other central banks, especially in the US or the BOJ,
Hmm.
because in Japan we have seen the rise in inflation after a long time, and their withdrawing accommodation in terms of rate hikes or reducing their bond purchases is a reaction to higher inflation.
Right.
Similarly, in the case of US, we are seeing continuous growth, continuous high growth, relatively high growth in the US economy,
Okay.
and the fact that the inflation is not coming down to the Fed's target, which is
Hmm.
preventing Fed from cutting rates in this calendar year. They have cut rates last year, but they have not cut rates in this calendar year. So I think
Sure.
they are waiting for more subdued inflation before they again embark on a rate cutting cycle. Obviously, they are forecasting more rate cuts to come, but I think probably we'll have to wait and see how this growth inflation dynamic plays out in the developed economies. But overall, just to answer your query, I think every central bank is looking at domestic
Hmm.
growth inflation dynamics, and obviously they are looking at the geopolitical scenario also, but that will probably take a backseat. The foremost consideration for them in the conduct of monetary policy should be their domestic demand inflation dynamics.
Absolutely. And let's also, get your viewpoint on the, what FPIs or FIs are doing at this point in time. In fact, we are seeing, FPIs are continuing to sell Indian fixed income assets despite the improved macro indicators. So,
Right.
if you can just, shed some light on what's happening at this point in time, how are you reading into this trend?
I think so. We have seen a decent amount of inflows in 2023 and 2024. Both these
Exactly.
2 years, we have seen a decent amount of inflows into fixed income from FPIs. Last 3 months, I mean, if you talk about the last quarter, April to June, we have seen some
Mm.
outflows. I think it can be a function of some profit booking, taking some profit off the table, because we have seen a decent return from Indian fixed income assets over the last 2 years.
Mm. Mm.
See, I mean, just the 10-year benchmark yield, it has
Mhm.
come down from a high of around 760 in 2022 uh, to a low of six quarter just a fortnight back.
Okay.
All the FPIs who have been investing over the last 2 years, they have seen decent returns on their portfolio investments. So I think it can be a case of profit taking, and also the fact that probably the US Indian interest rate differentials have come down,
Mm.
and maybe there will be some reallocation of capital. But I will just say that it's more, it looks like more a case of profit booking to us rather than anything else. Because our macros, as you rightly pointed out, continue to stay quite strong and stable. And
Right.
going ahead, also, we expect the macros to remain stable. So, from a macroeconomic stability, I think India is in a sweet spot. There's no worries on that account. It can be more a question of tactical reallocation after a strong rally in Indian bonds over the last 2 years.
Absolutely. So no red flags there for
Yeah,
Indian. Great. Well, on that note, thank you so much for your time, Puneet. And that's all for now. But do still on to ET Markets live stream for more investment and trading ideas. Again, thank you so much for your time.
thank you very much. Thank you.